People think bank failures happen because banks run out of money. They assume mismanagement or bad loans cause the collapse. But the cash is secondary. The real mechanism is access. When banks shut down, your wealth does not disappear. It becomes unreachable. The numbers in your account still exist on a ledger somewhere. You see them on a screen. You know they belong to you. But you cannot touch them, spend them, or convert them to anything useful. The distinction between having money and accessing money is the difference between financial security and financial paralysis. Banking systems operate on concentrated infrastructure. 4 institutions control 40% of all American deposits today. This concentration creates bottlenecks. Every transaction, every paycheck, every bill payment flows through a handful of gatekeepers. When those gatekeepers close their doors, the entire machinery of exchange stops. Your employer sends your salary, the bank receives it, you cannot withdraw it. The leverage shifts entirely to the institution holding your funds. Money does not make you secure. Access to money makes you secure. And access is controlled by systems engineered by people you will never meet, operating under rules you never agreed to. You are watching Noob Historian. The official story is the first lie. The money trail is the first truth. This pattern has repeated across continents and decades. In 1933, Franklin Roosevelt closed every bank in America for 8 days. In 2001, Argentina froze all accounts and told citizens they could withdraw $250 per week from their own savings. In 2013, Cyprus took 47.5% of large deposits and called it a bail-in. 3 different countries, 3 different eras. The same playbook. The banks in your town operate on the same structural vulnerabilities. The 2293 collapse of Silicon Valley Bank saw $42 billion withdrawn in a single day through smartphone apps. The Federal Reserve now lists cyber attacks on banking infrastructure as a top-tier systemic risk. The concentration of deposits in 4 megabanks exceeds pre-1933 crisis levels. This is not ancient history. This is a blueprint for what happens when the system you trust with your paycheck, your mortgage, and your retirement decides to lock the doors. On Saturday, March 4th, 1933, Franklin Delano Roosevelt took the oath of office as the 32nd President of the United States. By Sunday night, he had signed Proclamation 2039. By Monday morning, all 18,000 banks in America were closed. No withdrawals, no deposits, no access to safe deposit boxes. The entire financial system of the world's largest economy went dark. The official explanation was panic prevention. In February 1933 alone, Americans had withdrawn $178 billion from their accounts. Lines stretched around city blocks. Fistfights broke out. Banks called in loans to meet withdrawal demands, crushing businesses and farms. The banking system was bleeding out. But the closure was not a pause. It was a restructuring. Treasury Secretary William Wooden and a team of examiners spent those 8 days reviewing every bank in the country. They sorted institutions into 3 categories: solvent, in need of reorganization, or insolvent. The examination was rushed. Teams worked through the night with incomplete records. Decisions affecting millions of depositors came down to judgment calls made in hours. When the holiday ended, 4,004 banks never reopened. Their depositors received pennies on the dollar, if anything at all. The life savings of farmers, shopkeepers, and factory workers evaporated through administrative classification. The banks deemed solvent reopened with a new guarantee, the Federal Deposit Insurance Corporation. For the first time, the government promised to backstop deposits up to $2,500 per account. This insurance changed the relationship between citizens and banks permanently. You no longer needed to evaluate your bank's health. The government would cover losses. But the insurance came with a trade. Banks now operated under federal supervision. The government gained permanent leverage over the institutions holding American wealth. The Emergency Banking Act passed Congress in under 8 hours. Few legislators read the full text. The crisis demanded speed, not deliberation. Consider the mechanics of those 8 days from an ordinary citizen's perspective. You wake up Monday morning, your rent is due, your grocery bill needs payment. Your employer owes you wages from last week. None of these transactions happen. The butcher cannot accept payment because he cannot deposit it. Your landlord cannot process your check because his bank is closed. Your employer cannot access the payroll account. Cash becomes the only functional currency. Those who withdrew early, who hoarded bills and mattresses and coffee cans, find themselves with purchasing power. Those who trusted the system, who kept their funds and accounts, find themselves without access to their own property. The Federal Reserve Bulletin from April 1933 documents the return of confidence. Within 3 weeks of reopening, Americans deposited more than they had withdrawn during the panic. The holiday worked by forcing a binary choice. Trust the reorganized system or operate entirely outside it. But 4004 communities learned a different lesson. When the bank does not reopen, there is no insurance payout coming. There is no appeal process. There is only the administrative judgment of Treasury examiners who spent hours reviewing books for institutions they had never seen before. Federal Reserve Board meeting minutes from March 1933 reveal the internal debates. Some officials pushed for a longer closure to conduct thorough examinations. Others warned about economic collapse if the shutdown extended beyond 2 weeks. The 8-day timeline was a political calculation, not a technical assessment. The banks reopened. The economy stabilized. History records the bank holiday as a success. What history often omits is the permanent expansion of federal control over private banking, the depositors who lost everything in closed institutions, and the precedent established for future shutdowns. The government learned it could close every bank simultaneously and survive the political consequences. That knowledge has never been forgotten. 68 years after Roosevelt's bank holiday, Argentina's economy was collapsing under a fixed exchange rate pegging the peso to the US dollar. The peg had brought stability in the 1990s. By 2001, it had become a straitjacket. Argentine exports grew uncompetitive against neighbors with weaker currencies. Unemployment reached 18%. The government borrowed heavily to maintain the fiction of peso-dollar parity. Foreign creditors grew nervous. Capital began flowing out of the country. On December 1st, 2001, Economy Minister Domingo Cavallo announced the Corralito, meaning little corral or little fence. The restrictions allowed Argentines to withdraw a maximum of $250 per week from their own accounts. Transfers abroad were prohibited. The government had fenced citizens inside their own banking system. The official justification was preventing capital flight. If wealthy Argentines moved their dollars abroad, the entire financial system would collapse. The Corralito was presented as a temporary measure to restore confidence. It lasted over a year. Central Bank of Argentina records document the economic devastation. GDP contracted 10.9% in 2002. Poverty rates doubled. Middle-class Argentines who had saved for decades watched their purchasing power evaporate. But the Corralito's true impact came from the pacification in early 2002. The government abandoned the dollar peg and converted all dollar-denominated deposits into pesos at an artificial exchange rate. If you had $10,000 in your account, you now had 10,000 pesos. But the peso immediately collapsed to a third of its previous value. Your savings lost 70% of their purchasing power through government decree. Over 170,000 Argentines filed legal challenges. Courts sided with depositors in many cases, but enforcement proved difficult against a bankrupt government. The extraction of wealth from the middle class to pay foreign creditors and stabilize the banking system was complete. The Corralito reveals a pattern absent from the American bank holiday. Roosevelt closed banks, but preserved the currency. Argentina closed access to accounts and then destroyed the currency's value while funds remained trapped. The combination was devastating. Consider the mechanics from an Argentine depositor's perspective in December 2001. You have saved $30,000 over 20 years of work. You kept it in a bank because the currency was pegged to the dollar. Your savings were safe. Then the Corralito arrives. You withdraw $250 per week while watching the news with growing alarm. By February, the government announces pacification. Your $30,000 becomes 30,000 pesos. Within weeks, 30,000 pesos will purchase what $10,000 purchased before. You did not make bad investments. You did not gamble on risky assets. You saved in the most conservative way possible, in a dollarized account at a major bank, and lost 2/3 of your wealth. IMF Staff Country Report. Number 03.226 provides clinical analysis of the crisis. The report documents how the deposit freeze prevented a disorderly collapse of the banking system. From the IMF's perspective, the Corralito worked. The system survived. The cost was borne by depositors rather than foreign creditors or international financial institutions. The Argentine middle class developed permanent distrust of domestic banks. Dollar holdings in overseas accounts and physical cash became standard practice. Real estate purchases replaced bank savings as the primary wealth storage mechanism. The financial system survived, but the social contract between citizens and banks shattered. This distinction matters. Banks operate on trust. You deposit funds because you believe you will retrieve them later with interest. When that trust breaks, it does not rebuild in a single generation. Argentine banks still struggle with deposit to GDP ratios far below regional averages. The Corralito's shadow extends over 2 decades. The Cypriot banking sector had grown to 8 times the size of the island as GDP by 2012. 2 banks, Laiki Bank and Bank of Cyprus, held most deposits. These institutions had invested heavily in Greek government bonds. When Greece restructured its debt in 2012, Cypriot banks absorbed catastrophic losses. The banks needed bailout funds. Cyprus turned to the European Union and International Monetary Fund. The initial proposal, announced March 16, 2013, shocked depositors across Europe. Every deposit in Cyprus would receive a haircut. Accounts under $100,000 would lose 6.75%. Accounts above $100,000 would lose 9.9%. For the first time in the Eurozone, insured deposits below the guarantee threshold would be seized to recapitalize failing banks. The Cypriot parliament rejected this proposal after public outrage. Banks remained closed while negotiations continued. ATM withdrawals were limited to $100 per day. International transfers were blocked. After 9 days of closure, a new agreement emerged. Deposits under $100,000 at Bank of Cyprus and Laiki Bank were protected. Deposits above $100,000 at these institutions faced a 47.5% haircut. Nearly half of large deposits disappeared. European central bank documentation reveals the mechanics of this bail-in. Traditional bank rescues use government funds or central bank lending. Bail-ins use depositor funds. The money does not come from taxpayers. It comes from the accounts of customers who chose to deposit at the failing institution. The policy rationale was moral hazard prevention. If governments always rescue failing banks, banks have incentives to take excessive risks. If depositors face losses, they will monitor bank behavior more carefully. But this rationale assumes depositors possess the expertise to evaluate bank investment strategies. The Russian businessmen with large Cypriot accounts may have failed this standard. The British retirees who chose Cypriot banks for higher interest rates on pension savings did not deserve to become involuntary bank investors. European Stability Mechanism documents detail how the haircut was calculated. Bank of Cyprus needed $4.2 billion in new capital. Deposits above $100,000 totaled approximately $8.8 billion. The 47.5% seizure generated sufficient capital to meet regulatory requirements and keep the bank operating. The mathematics were precise. The human impact was devastating. Consider the experience of a small business owner with $300,000 in operating capital at Bank of Cyprus. You maintain this balance to cover payroll, inventory purchases, and lease payments. The $100,000 protection threshold sounds generous until you realize your operating cushion was $200,000 above this line. Capital controls remained in Cyprus for 2 years after the crisis. Citizens could not move more than $3,000 abroad without special authorization. Checks could not be cashed. The island's economy, dependent on financial services, contracted sharply. The Cyprus bail-in established a template. The European Union subsequently adopted the Bank Recovery and Resolution Directive, making bail-in the default mechanism for future bank failures across the Eurozone. Deposits above insurance limits now function as unsecured loans to the bank. If the bank fails, your funds become bank capital. This is not theoretical. This is current European law, and similar resolution frameworks exist in the United States under the Dodd-Frank Act's Orderly Liquidation Authority. 3 case studies, 3 continents, 3 different political systems, 1 pattern, Bank for International Settlements. Working paper number 852 analyzed 147 systemic banking crises since 1970. The research identifies consistent sequences across geographic and temporal boundaries. Phase 1. Denial. Officials insist the system is sound. Individual bank failures are described as isolated incidents. Depositors who withdraw funds are called alarmists or worse. During this phase, those with connections or information exit the system. Those without connections remain trapped. Phase 2. Sudden closure. The announcement arrives without warning. A Friday evening press conference. A weekend proclamation. The timing ensures markets are closed and immediate reaction is limited. The closure is described as temporary, a pause to restore confidence, a holiday to permit restructuring. Phase 3. Reorganization. Behind closed doors, officials determine which institutions survive and which disappear. Depositors have no representation in these discussions. The decisions reflect political calculations, relationships between bankers and regulators, assessments of systemic importance. Small community banks fail. Large institutions merge or receive support. Phase 4. Modified reopening. Banks resume operations under new rules. Withdrawal limits, capital controls, currency conversions, insurance changes. The system that reopens is not the system that closed. Depositors discover their relationship with their bank has been rewritten without their consent. Phase 5. Permanent institutional change. Emergency measures become permanent features. The FDIC, created in 1933, still exists. Argentine capital flow monitoring, established in 2001, persists in modified form. European bail-in rules written after Cyprus now govern all Eurozone banks. Crises create durable institutional changes that outlast the emergency. Journal of Monetary Economics Research by Calamiris and Mason examined bank-level data from 1933. Their analysis identified which characteristics predicted bank survival versus failure during Roosevelt's holiday. The findings challenge comfortable assumptions. Size mattered less than political connections. Geographic location influenced outcomes beyond financial metrics. Banks and districts with influential congressmen showed higher survival rates, controlling for other factors. The examination process that determined life or death for 18,000 institutions contained systematic biases invisible to depositors. This pattern reveals the structural position of ordinary depositors within banking crises. You provide the fuel, the deposits that banks transform into loans and investments. You bear the risk when those investments fail. You receive the smallest return when investments succeed. You have no seat at the table when crisis decisions are made. The incentive structure creates predictable outcomes. Bank executives capture upside through bonuses and stock options during good years. Depositors capture fixed interest payments far below bank profits. When crisis arrives, executives retain compensation already received. Depositors absorb losses through frozen accounts, haircuts, or currency devaluations. This is not conspiracy. This is structure. The system was engineered this way. The gatekeepers who designed deposit insurance, resolution frameworks, and emergency procedures created rules that protect the system first and depositors second. The 2024 Federal Reserve Financial Stability Report contains language that should concern every depositor. Cyber attacks on banking infrastructure now rank as a top-tier systemic risk. The report details scenarios where coordinated attacks on multiple institutions could trigger the same closure sequences documented in historical crises. The 2023 ransomware attack on Ion Trading Technologies demonstrated the fragility. Ion provides trade processing services for derivatives markets. The attack disrupted operations at banks across multiple continents. Resolution required days. A similar attack targeting deposit-taking institutions could freeze the payment system. Swift network security assessments classify banking system cyber vulnerabilities as the most probable trigger for a modern bank shutdown. The network processes trillions of dollars in transactions daily. A sustained attack could make banks unable to confirm balances, process payments, or transfer funds. But cyber risk is only one vulnerability. FDIC data reveals a concentration of deposits exceeding pre-1933 levels. 4 banks, JP Morgan Chase, Bank of America, Wells Fargo, and Citibank, hold 40% of all U.S. deposits. In 1933, thousands of small banks created a distributed system where individual failures caused local damage. Today, a single institution's failure threatens national economic function. The March 2023 bank failures proved how digital banking accelerates crisis timelines. Silicon Valley Bank lost $42 billion in deposits in a single day. Depositors used smartphone apps to transfer funds. No lines around the block, no physical presence required. The bank run happened at the speed of Wi-Fi connections. Federal regulators intervened within 48 hours, guaranteeing all deposits, including those above the $250,000 insurance limit. The intervention prevented contagion, but established an expectation. Large depositors at systemically important banks will receive full protection. The moral hazard problem, Cyprus attempted to address through bail-ins, remains unresolved in America. Signature Bank and First Republic failed in the same period. Combined assets of the 3 failed institutions exceeded $532 billion. The failures demonstrated that digital-age bank runs create pressure traditional frameworks cannot contain. The response to these failures accelerated Federal Reserve research on central bank digital currencies. Fed research papers on CBDCs explicitly reference financial system resilience and payment system continuity as primary motivations. These phrases echo the language used to justify emergency measures in 1933, 2001, and 2013. A CBDC would allow the Federal Reserve to provide payment services directly to citizens without commercial bank intermediation. During a banking crisis, the Fed could maintain transaction capabilities even if private banks closed. The CBDC becomes the contingency plan for the next bank shutdown. But this contingency contains its own implications. A Federal Reserve CBDC would give the central bank direct visibility into all transactions. Cash provides anonymity. Commercial bank deposits provide privacy subject to legal process. A CBDC provides neither. Every purchase, every transfer, every payment would exist on a federal ledger. The infrastructure for response to the next banking crisis is being built now. The choices made in design phases will determine what rights depositors retain when crisis arrives. The historical record provides specific guidance for what happens when banks close. The sequence is predictable. Your response determines your outcome. First, understand that the announcement will come without warning. Roosevelt signed Proclamation 2039 on Sunday night. Argentina announced the Corralito on Saturday. Cyprus closed banks following a Friday night Eurogroup meeting. Crisis managers choose moments when markets are closed and public response is limited. You will not receive advance notice. Second, recognize that temporary measures extend indefinitely. The 1933 bank holiday lasted 8 days, but 4,004 banks never reopened. The Argentine Corralito was announced as a 90-day measure and lasted over a year. Cypriot capital controls persisted for 2 years. The initial timeline provided by authorities reflects political needs, not operational reality. Third, accept that currency access determines survival. In every bank closure, those with physical cash maintained purchasing power. Those dependent on electronic balances faced rationing, delays, and losses. The grocery store does not accept frozen deposits. The gas station does not process payments through closed banks. Cash in hand outperforms wealth on paper. Fourth, understand your position in the hierarchy. Deposits above insurance limits are unsecured loans to your bank. If the bank fails and bail-in protocols activate, your deposits become bank capital. The $250,000 FDIC limit exists for a reason. Funds above this threshold carry risks you accepted by depositing them. Fifth, monitor concentration. Your deposits at a single institution face correlated risks. Diversification across institutions, across account types, and across asset classes reduces your exposure to any single bank's failure. The Federal Reserve, Treasury Department, and FDIC have contingency plans for the next crisis. Those plans prioritize system stability over individual depositor outcomes. The 1933 holiday worked from a system perspective, even though 4,004 banks closed permanently. The Argentine Corralito preserved the banking system even as middle-class savings evaporated. The Cyprus bail-in recapitalized failed banks at depositor expense. Your interests and system interests align during normal operations. During crisis, they diverge. The BIS research on 147 banking crises since 1970 documents recovery timelines. GDP typically requires 3 to 5 years to return to pre-crisis levels. Employment recovery takes longer. Depositors who lose funds during restructuring rarely achieve full recovery. But the same research documents protective factors. Diversified savings across multiple institutions and asset types reduce individual losses. Physical cash holdings maintain short-term purchasing power during closures. Real assets, including property and durable goods, retain value through currency crises. None of this information appears in your bank's marketing materials. The system depends on your confidence. If depositors acted on historical patterns by diversifying aggressively and maintaining cash reserves, banks would face reduced deposit bases and higher funding costs. Your trust subsidizes their operations. The question is not whether another bank shutdown will occur. BIS data shows these events happen with regularity across developed and developing economies. The question is whether you will face it with the same preparation as the Treasury officials who designed their response protocols, or the same vulnerability as the depositors who bear the costs. The historical record is clear. The pattern is documented. The vulnerabilities are public knowledge. When the next bank holiday arrives, the announcement will reference temporary measures, confidence restoration, and orderly restructuring. You will hear echoes of Roosevelt, Cavallo, and the Eurogroup. The language of crisis management has not changed in 90 years because the playbook has not changed. The difference in outcomes will depend on decisions you make before the announcement, not after. The machinery of modern banking concentrates deposits in fewer institutions than at any point since 1929. The infrastructure of digital banking enables runs faster than any regulatory response. The legal frameworks of resolution authority assign losses to depositors rather than taxpayers. The pressure points are visible to anyone examining the system. The flow of your paycheck, your savings, your retirement funds passes through gatekeepers operating on leverage ratios and liquidity requirements designed to survive normal conditions. Abnormal conditions arrive without warning. Roosevelt closed 18,000 banks on his second day in office. Argentina froze accounts after a decade of apparent stability. Cyprus haircut depositors, while the European Central Bank assured markets the system was sound. The official story is always the first lie. The money trail is always the first truth. And the trail leads directly to your bank account, waiting there for the next time history repeats its reliable pattern. The documentation exists. The precedents are established. The infrastructure for emergency response is in place. The only variable remaining is whether you will face the next shutdown with preparation or surprise. 90 years of evidence, 3 continents of case studies, 1 pattern with 1 outcome. Your move.